Yeah, we start today's market talk. This is particularly relevant to India. The real test is whether the policymakers can keep inflation anchored, the rupee stable, and the growth intact simultaneously over a sustained period. Because it is not easy to do everything together. And what the government did was, government and RBI in the last week they pulled out all the stops to attract foreign capital and stabilize the rupee. The only thing is to be seen is will these measures be enough to entice foreign investors back? Estimates are 30-40 billion dollars will come in, but we'll have to see. Rate hikes would defend the currency and contain inflation, but risk killing the demand because it works both ways. While holding rates risks the opposite. So what happens if you hold the rates at these levels? The currency keeps depreciating, inflation keeps going up. So they have to find a nice balance between everything else. So what has happened is RBI has bought itself some time, but the amount of time available to RBI depends on the choke point in the Persian Gulf that lies outside the RBI's control. So RBI can only do as much. They can't control the choke point. Now the market outlook. See, there are two things which are very important. One, AI is either the surest sign of coming golden age or the clearest symptom of a bubble. Please switch off your volumes. Now, what has happened is Alphabet has announced it would raise 80 billion in fresh equity recently. A company that generates 174 billion in operating cash flow is now diluting its shareholders to keep up with the trend. The basically, as I had spoken earlier, also it is related to Microsoft. Earlier, when this PC revolution started and Microsoft got left behind, and now this time nobody wants to be left behind, so they will keep doing capex. Now, amounts being committed to AI data centers run into trillions. Hardware there becomes obsolete every few years and must be replaced. Profits which these guys make will need to service such spending, capex spending, etc., exceed the combined earning of entire industry. So right now, people are not seeing profits, but they have to keep up. The for most of them is under investing vastly outweighs the risk of over investing. Now, the perfect example is Indian IT company. They have not invested and they are left behind. It translates into structural EBITDA margin expansion. As we are seeing with Claude and Anthropic, etc., their margins have suddenly gone up, profits have gone up, and it helps in securing early mover data compute advantages and locking in enterprise clients. So those who will be left behind will be permanently left behind and they will not be able to cope up. Now, after the RBI's action, there is a strong possibility of 50 to 75 basis point rate hike in the second half of FY27, especially if the risk of inflation expectations get exaggerated by below normal monsoon and El Nino effect on food inflation. RBI is on a pause as it wants to assess the growth inflation dynamics. Now, if you see, these are the forecasts of the RBI for FY27. They have raised their full year. They have raised their inflation expectations to 5.1, and they are expecting in the second half the inflation will go higher. So from this slowly it will go up from around 4 to 5.1, then 5.9, and so that is their expectations. And they have lowered their growth forecast. So it has come down for full year, it has come down to 6.6. So generally it has been lowered from 7 plus to the 6 level. So this is what they have done. Inflation forecast is higher, growth estimates are lower. So what they have done is non-monetary measures have been unleashed to salvage the rupee right now. But the risk to agricultural output increases due to El Nino, which may negatively impact rural demand. So that is the big risk, and that is why they are keeping some ammunition dry right now. Now, the result was that the rupee strengthened against the dollar. it has come to now below 95 level. All these measures saw some easing of the negativity on the rupee. The bond yields also came down. They have come below 7. So people were expecting a rate hike, etc. So that has got negated. So the bond yields have come down. And India VIX has come down. So if you see, India VIX has now come below 16 and it is heading lower. So with it had gone to around 14 level, but then suddenly it spiked up because of again indecision in the Middle East. Now coming to FIDI data, FIs are net short on index futures. They have sold index option calls and bought puts and have bought puts option. So they are strongly bearish and they have sold in cash also. Roughly $1 billion they are selling in most days. Proprietary traders, they are long on index futures. They have bought calls. They have also bought puts also. So they are generally indecisive. Now coming to clients. Clients are, they bought index futures. So they are net long here. They have bought calls. They have sold puts. And it's a big positioning. More than 8 lakh put options for index they have sold. So they are strongly bullish, and DIs have been buying in cash. So if you see here, last week on Friday there was a big selling by cash selling. It brought the index down to around 23,500 level. And this week, if you see on 2 days, the FIs have been net bearish in terms of index futures, and the Nifty went down. And on Friday again, they were sold. They sold index futures. They sold calls. They bought puts. So again, the index went down, but it is generally at the same level. So now coming to US, strong May jobs report pushed 10-year yield above. So if you see, the 10-year yield has gone above 4.5, as probability of rate cut has been reduced, but it has not really shot up to 5 or that the market should react so violently. And the dollar index, strong economy means rates stay higher for longer and a lot of money comes into the US. There is a lot of demand for dollars. So the dollar index went to 100. Now the net impact is that the emerging market currencies sell off, the dollar strengthens, and the metals also correct. Brent crude is generally at same 92, 93 level. It's not moving much because there is not much of news coming from Middle East now. Gold corrected along with other assets. It has now fallen below the crucial support, which was at around $4,400 to an ounce. So let's see till what level it goes down. But from here on, it goes to around 4,000 odd level. That should be a chance to buy this, get into gold, etc. Similarly, silver, it has broken the crucial support. So again, let's see till what level it goes down from here. But it has broken the support. So if it doesn't bounces above the $70 to an ounce level, it will head lower. And along with because of rise in dollar, the copper corrected. It was nearly down 1% odd. So it has come down. Bitcoin corrected, has come down to 60,000 level. So there's a lot of selling in most of these assets. Basically, people are trying to get into money, cash, to be able to apply for all these high profile IPOs, including SpaceX, which is going to come in the US. S&P 500 corrected around 2.5%. It had risen too much. There is a lot of scope. Till the time it comes to around this 7,000 level, it can easily correct and still remain in the bull market. Similarly, for Nasdaq, I think it will come down into this range. Now it had gone above the trend line, rising trend line. It will come down to this rising trend within this level, and then will keep moving. So there is nothing to panic as such, but just that leverage positions get closed. So 4.5% decline in last week, and Dow was down 0.3. So this has corrected less because it had moved up also lesser than the others. The basic concern was strong economy means rates stay higher for longer. And the most sensitive to interest rate assets got hit the most. That is semiconductors, AI, cryptos, etc. They corrected, and gold, silver, all corrected the most because they are most sensitive to interest rates. Now coming to India, Nifty 50 on a weekly chart. So if you see there, we are having a channel which is downtrending now. We are constantly making lower highs and lower lows. So it is trending downwards right now. It was a weekly bearish candle on Nifty with shadows on both sides showing indecisiveness. Now, if you come to the daily chart, see, it has fallen into this gap, tested the low of the gap at 23,150, then bounced from there. But if you see last four trading sessions, it is near the previous swing low of 23,150. So it is just testing that. Uh, Now, if there is a big decline on Monday, if it holds 23,000, it will be good. And if it bounces back from there above this, will be otherwise this will become a resistance now, 23,150. So that has to be seen. Nifty Bank is showing relative strength. Uh, and if you see, since banks are showing relative strength, IT has been underperforming. So Nifty Bank on the weekly chart made a small bodied candle with long lower shadow. The shadow is long, showing that there is an interest at the lower levels. On daily chart, so if you see, it has closed above the 20 EMA, which is showing some strength and has risen from the lower levels. So I think 53,000 should be a decent support, and it has to go above 55,000 for some strength, etc. Midcaps corrected profit booking here 2.5%, but it is still somewhere closer to the high, so nothing much to worry. Similarly, with small caps, they also corrected, but corrected lesser. Now, the problem is HDFC Bank, one, it is making lower highs, lower lows, and it is drifting downwards. And I think this 725 level would be crucial. If it breaks, then it'll go to test this 700 level, which is its slightly long-term support, though it is slightly oversold here. So we'll have to see this. The other big issue for the Nifty is that Reliance has broken the crucial 1300 odd levels and the support where it was taking support. But that is normal. If you keep testing a support number of times, one day it will break. It has got sold off, and now let's see, it will maybe it may test lower levels, 1240, 1200, who knows. So this is getting sold off, and that is keeping the market low. The other thing which sold off was TCS. See, it got there was an enthusiasm on one day, it went up, and then has corrected much more. So it remains in a downtrend, the IT, and because of lack of earnings visibility. And if you see this year only, from roughly 3,300 level, it has come down to 2,200 level. So roughly a 50% fall has taken place. So so it is not showing any strength as such and not able to go up. Now I'll talk about two stocks today. First is Tenneco Clean Air. It's a global company, global tier one player and market leading automotive component supplier. As a holding company, Tenneco, they have presence in 28 countries, strong revenue, 180 manufacturing plants, etc. Uh, they have good customer relationship with a lot of clients, uh, and they are into product categories like clean air, powertrain, ignition, performance solutions, advanced ride technologies, braking, etc., and this drive technology aftermarket support. The Indian entity Tenneco Clean Air offers diverse product offering for key end markets. Basically, they have two segments: clean air and powertrain solutions, and advanced ride technologies. Now, in clean air and powertrain, they make these DOC and SPDF systems. DOC is diesel oxidation catalyst, basically to curb the pollution, And SPDF is selective catalytic reduction coated diesel particulate filter. Both are advanced exhaust after treatment systems. So these are very relevant with the present system or present emphasis on clean exhaust and managing all the carbon which is coming out. So this technology is very relevant. And these are the other items. And then in advanced right technologies, they are basically making shock absorbers of various types, so which they are giving for CVs and PVs, etc. Uh, Now, it's a prominent tier one auto ancillary supplier in Indian markets, specializing in emission control technologies, exhaust after treatment systems, and ride performance solutions. Backed by its global US based parent group, it's a key beneficiary of tightening domestic emission standards and hybrid ICE powertrain architectures. It continues to strengthen its pipeline through multiple order wins across clean air, their first program with a Japanese PV OEM, and after treatment program from a European CV OEM, and entry into bearing systems and advanced ride technology segments, expanding multiple new DCX application. DCS suspension was launched in Q3 FY26. DCX is double comfort extreme suspension. I'll talk about it. Successful completion of a Euro 7 proof of concept with a European truck OEM enhances its readiness for future emission regulations and create opportunities for participation in next generation vehicle platforms. It launched its DaVinci DCX double comfort extreme suspension, a mechanical system that offers enhanced ride comfort at an affordable price and is expected to capture a large share of the Indian market with a leading Indian PV OEM in Q3 FY26, reinforcing its leadership position in shock absorbers. With a robust and diversified order book around 12,400 crore in FY26, visibility for healthy double-digit growth remains strong, supported by resilient demand, tightening emission norms, Cafe 3, and rising exports. Capacity expansion in Western India for advanced ride technology segment with a capex of 69 crore, and Kharkhoda announced in Q3 FY26 with a capex of 71 crore enhances medium-term scalability. Now coming to their quarterly earnings, uh, the value-added revenue was up quarter year on year around 17.5%. EBITDA up 17.6%. Margins were flat, and PAT was up 18.9%. So this quarter was strong, and because of which the stock moved up. And if you see here, year on year growth was more in advanced ride technology segment as compared to the clean air and powertrain. This has been moving strongly, and as compared to uh, Q4 FY25, margins are also stable, and EBITDA also went up 17.6%, and the contribution or the mix is now even for both segments. Now, if you see over a period of time, uh, their revenues has been growing strongly. So between FY25 and FY26, it went up 12%, EBITDA went up 14%, and PAT was up 9%. Uh, but steadily, they have been growing at 20 odd percent. Now, the key metrics to be watched, their net debt to equity. So they have retired some debt. Fixed asset turnover is very strong, and this is particularly important to track. 9.6 times X fixed asset turnover. So that is outstanding. That means they are able to utilize the facilities excellently. Net working capital days have come down. So that means their cash management is good. ROE is very strong. 43% ROE is super, and ROC is at 94%. Cash conversion cycle is lower, so that again is good. They are optimizing capacity through focused capex, 12 manufacturing facilities, and 2 R&D centers of global standards. So they have these clean air and powertrain solutions at various places: Chakan, Chennai, Pitampura, again Bhiwadi, etc. And then advanced ride technology, Pondicherry, Sanad, Pune, Bawal, Hosur, etc. Now, coming to FY27 expected earnings, they're expected to grow around, see, I told you around 12,500 crore order book, and they've done around 5,400 crore in net sales. So they're expected to do around 6,000 or 6,280 odd crore in FY27. So that means they have a order visibility of 2 years. Margins are steady. uh, Sales growth is around 15-16%, and EBITDA growth, EPS they will get 18, but EPS growth is also same double digit, 15-16%. So, and 18, and then in FY28 they are talking about 23. So taking a mean of 20 at around 30 times. So this is a decent stock with good pedigree, etc., and good parentage. At so 20 EPS, 30 times should be good. Asset turnover is very strong, as I told you. ROE is again strong, expected to be strong. So this stock is a good business. Now, if you see here, it got listed recently and has been constantly moving up. After the earnings, it went up to 600 plus, has corrected, it's coming down. So if you get it somewhere around this 550, 560 levels, it should be a good stock to hold for long term. Don't expect outstanding, moves and all, but it should be a decent stock to hold because the business is in good segments for this company. Now the other one is Rubicon Research. Uh, it is a R&D driven formulations manufacturing and marketing company focused on regulated markets, means US. Uh, it has delivers specialty products, drug device combinations, and complex generics. Wide basket of 76 active ANDAs. ANDAs are abbreviated new drug applications, and 8 active NDAs. NDAs are new drug applications. So basically, it takes an existing approved drug, reformulates it to create a brand new drug applications and markets it. So that is what it is good at. So it's a good in generic business. uh, so right now they have a branded specialty and complex generic portfolio, three branded products with no AB rated generic alternatives. So that's why they have a clear path, robust manufacturing sites and R&D capabilities, and decent leadership. Two US FDA inspected R&D facilities across India and Canada. Now, it's a rapidly emerging innovation driven specialty pharmaceutical company that focuses on drug delivery technologies and complex generic formulations. It achieved an average price per unit growth of approximately 8%. This is driven by its explicit focus on low competition complex formulations such as drug device, nasal sprays, and oral liquids, where it can secure first mover advantages. It captures over 98 to 99% of its revenue from regulated markets, primarily the US. It possesses 72 active ANDAs and 9 NDAs. It maintains a commercialization rate of 92%, converting approvals to live market launches, far outstripping industry standard laggards. It commands greater than 25% value market share in 9 of its distinct commercialized products. Specialty products maintained a steady contribution of 32.8% to gross profit, reaffirming the structural shift in portfolio mix. It acquired an 85% equity ownership in Ahmedabad-based Arena Life Sciences. This deal serves as its official launchpad into Indian domestic formulations market. So they are now trying to get into Indian market. Arena is a pure play specialist in central nervous system and neuropsychiatric therapeutic categories. It commands a strong domestic network connecting 4,000 plus targeted prescribers, primarily neurologists and psychiatrists across India, supported by an established web of stockists, distributors, and retail pharmacies. So, what is has got by acquiring Arena Life Sciences is a full network, so as to get into this CNS system, because their sales in CNS is very strong in the US. The basic problem is temporarily negative free cash flow profile due to aggressive inventory scaling. If you see this quarter, the revenue was up 43%, EBITDA up 63%. Margins improved by roughly 3% plus, and PAT more than doubled. So good performance in this quarter. For the full year also, they did 36% revenue growth and 83% profit growth. So 12 approvals in FY26, 77 commercialized until FY27. So FY26, so they are on a upward trajectory on this. Share of specialty products approved to 32.2% of gross profit. So again, upward trajectory so margins are improving because of that. Revenue to post 25% CAGR over FY26-28. So they are working on 25% CAGR. For revenue, gross margin to gradually recover by FY28. Right now, gross margins are down because of capex, etc. Expected EBITDA CAGR of 25% over FY26-28. ROCE to improve with better utilization of assets. Above 20% ROE, ROC is good. So basically, 25% revenue growth, 25% EBITDA growth, margins to improve, and ROE above ROCE above 20%. So decent business. So 84 products approved products as of 31st March 26. 92 91.7 commercialization rate in the US, steadily broad-based portfolio and growth over time. So what is happening is their reduction in product concentration. So they are becoming more diversified in terms of their products. US sales and marketing companies, which are wholly owned subsidiaries, Advagen, markets non-branded prescription products to customers who include wholesalers, group purchasing organizations, pharmacy chains, and Validus Pharmaceuticals. Sales and marketing platform for Rubicon's branded prescription products. So Validus markets 3 brands that have no US FDA approved substitutable generics. So they have a good setup in the US for both developing of the products and marketing of the products. Now coming to estimates, FY27, they are expected to see a growth of around 30%. Margins are expected to go down a bit from 22.8 to 21.6, basically because of capex, etc. PAT is expected to grow at around 28% because of it has come down from the revenue rate because of lower margins, but roughly around 316-17 crores of PAT is expected. So if you see here, and in FY28 is expected to do a PAT of around 418 crores. So even if you take a mean of around 350-360 crores of PAT, their present market cap is 19,800 crore. So it comes to around 55p, slightly expensive for a pharma business. So they will do around 19.2 EPS in FY27, and 25 is expected. We'll have to see that. ROE and ROC is above 20. Inventory days, that's what I was talking about. They have gone up. So that there is a problem of cash flows, etc. So that has to be seen if they are able to reduce that. Now, this stock again was recently listed, and it has been steadily going up. Now, after the earnings, uh, for 3 days, we saw massive buying from 1,000 odd level. It went up to 1,300, and then corrected sharply around 7.37%. So somewhere around this 1,000 level should be a decent entry. Say, because if you see, we are talking about an EPS FY27, FY28 mean EPS of around 22 odd. So around 45-50 times it's okay. After that it becomes expensive. So if you get it somewhere where this gap is around 1,000 odd, that should be a decent point to enter this stock. It became overbought, so it has corrected also. So the point is, don't chase anything which is really spiking up. So in just 2 days, I'm sure some mutual fund would have bought it. So the stock went up like vertically upwards. So these things correct. So this is Rubicon Research. I've finished. We'll take questions now.